Most people hear tax the rich and think it ends there. They picture a clean transfer, rich people pay, the bill is covered, problem solved. But here is what actually happens in real systems. The richest people are the least trapped. They can move first, restructure first, and reduce exposure legally long before the tax even hits. And when that happens, the gap does not vanish. It gets pushed down the ladder until regular taxpayers make up the difference through higher payroll burdens, higher consumption taxes, higher fees, and lower service quality. Stay with me until the end, because I am going to give you a precise checklist of signals to watch. And if you follow that checklist, you can spot when a country is entering the early stage of capital exit versus the stage where consequences are already locked in. Like this video and subscribe now, because most Americans feel something is changing, but very few people are hearing the mechanism explained clearly. I am Marcus Blackwell. I study financial systems through patterns and incentives. I do not predict dates. I do not panic. I explain how the machine moves so you can stay calm while the headlines try to make you reactive. Now let me challenge the most common assumption right away. Most people think wealth leaves a country because of one policy, one tax hike, one election, one speech. That is not how it works. Wealth does not leave suddenly. It does not leave emotionally. It leaves structurally. It leaves through planning, through legal engineering, through quiet shifts in where the next deal gets done, where the next company gets formed, where the next investment gets committed. If you only watch the day someone officially leaves, you are watching the end of the movie, not the beginning. In a minute, I am going to show you what the beginning looks like, because that is where the real signal lives. Let us start with the data, not the drama, because numbers tell you intent long before headlines tell you fear. Major global wealth migration reports estimate that roughly 140,000 high net worth individuals relocate internationally within a single year. By their own methodology, that is the highest level ever recorded. On social media, that number is framed as an escape, a collapse, a rush for the exits. That framing is wrong. This is not a stampede. It is a directional signal. It is a map of confidence. Who are these people? They are not retirees chasing sunshine. They are business owners, founders, senior executives, investors, and internationally mobile professionals. People whose income is not tied to a single payroll desk. People whose assets can be restructured legally across borders. People who respond early to rule changes because delay is costly for them. What are they doing? They are not all leaving forever. Many are establishing secondary residencies, shifting corporate holding structures, or changing where future growth is booked. Some physically relocate. Many do not. But the economic effect is the same. New value creation moves. Where are they leaving from? Europe has been one of the most consistent net exporters of wealthy residents in recent years. The United Kingdom appears repeatedly at the top of outflow lists, with France, Germany, Italy, and Spain often following. In some projections, the UK alone is shown losing a five-figure number of millionaires in a single year. Again, that is not a population collapse. It is a confidence signal concentrated among the most mobile tier. Why are they moving? Not because taxes suddenly became high. These countries have had high taxes for decades. What changed was speed and uncertainty. Rules began changing faster. Enforcement became more aggressive. Reporting expanded. Political rhetoric hardened. And exit penalties increased. The future stopped feeling modelable. With what effect? Capital that would have been reinvested locally starts flowing elsewhere. Hiring decisions pause. Long-term projects get delayed. None of this shows up immediately in unemployment numbers or GDP. It shows up quietly in opportunity. How does this connect to you as a U.S. citizen? Because the same pressures build the same way everywhere. When predictability weakens, mobile capital adjusts first. And when it adjusts, the burden shifts to those who cannot. That is why understanding this map matters before the consequences show up in your paycheck, your taxes, and your cost of living. Now contrast that with the destinations that repeatedly show up as net gainers, because this is where the pattern becomes impossible to ignore once you see it clearly. Wealth does not scatter randomly across the globe. It concentrates in the same places for the same structural reasons year after year. At the top of the list, you consistently find the United Arab Emirates. The attraction is not just that personal income tax is effectively zero. That is the headline, but it is not the mechanism. The real draw is clarity. Residency rules are explicit. Time frames are defined. Enforcement is consistent. Business formation is fast. Investors know in advance how they will be treated. That predictability allows people to model their future with confidence. When uncertainty rises elsewhere, capital moves towards systems where the rules are legible. Next is Switzerland, which has been a capital magnet for generations. Switzerland is rarely the cheapest option. It is rarely the flashiest. But it offers something that matters more than both. Legal certainty. Property rights are strong. Courts are reliable. Tax frameworks evolve slowly and transparently. For long-term wealth, that stability is priceless. When global conditions become volatile, Switzerland absorbs capital not because it promises miracles, but because it promises continuity. Then there is Italy, which surprises many people until they look at the details. Italy introduced special flat tax regimes for qualifying new residents that clearly define how foreign income is treated. The key is not the rate itself. The key is that the terms are spelled out in advance and applied consistently. Investors know exactly what they are agreeing to. That clarity has pulled capital from higher friction systems without requiring secrecy or aggressive avoidance. And then there is the United States, which remains one of the most powerful magnets for foreign capital in the world, despite taxing worldwide income. Why? Because opportunity outweighs friction. Markets are deep. Capital markets are liquid. Legal infrastructure supports scale. Innovation ecosystems still generate outsized returns. Many investors accept higher taxes when the upside and institutional strength justify it. These systems are very different. Different cultures, different tax levels, different lifestyles. Yet they share one feature that dominates all others: predictability. That word is the entire game. Wealth does not chase perfection. It chases systems where tomorrow can be planned, priced, and trusted. Here is the first critical clarification. Most wealthy people do not move because they want low taxes. They move because they want rule certainty. If a system is stable, they can plan around high taxes. If a system is unstable, they cannot plan around even moderate taxes. That is why New York and California continued attracting capital for decades, even while taxes rose. For a long time, the institutional package was worth the price. Deep markets, enforceable contracts, talent density, reliable courts, global access. Those are not vibes. Those are assets. So if you are a founder, a hedge fund manager, or a global executive, you are not choosing a state the way you choose a cheap airline ticket. You are choosing an operating system. So why does it feel like this is changing now? Because tax policy is no longer arriving alone. This is the shift. In many parts of Europe and increasingly across North America, tax changes are arriving bundled with other signals that change behavior immediately. Retroactive enforcement, where rules reach backward into decisions made under old frameworks. Expanded reporting, where compliance becomes more intrusive and more punitive if you get details wrong. Public hostility, where wealth becomes a political target rather than a taxable base. And then the one that changes timing the most: exit penalties, exit taxes. If you understand exit taxes, you will understand why tax the rich often turns into the rest of us pay more without anyone admitting it. Stay with me because I will connect those dots cleanly and then I will give you the checklist. Exit taxes are one of the most misunderstood tools in modern tax systems. Many European countries use some version of an exit tax that treats unrealized gains as if assets were sold when a person or business relocates. The goal is simple: capture revenue before the taxpayer leaves the jurisdiction. And it is easy to hear that and think, good, that will stop them. Here is the reality. It often does the opposite. It changes behavior upstream. The United States applies a similar concept through its expatriation tax for certain high net worth individuals who give up citizenship or long-term residency. Canada uses departure tax rules based on a similar logic. The structure is not identical in every country, but the behavioral impact rhymes. When you tell mobile people that leaving later will be expensive, you do not freeze them in place. You start the clock in their head. And once the clock starts, preparation begins. Here is why. When exit taxes exist, the cost of leaving does not rise smoothly. It can rise sharply after thresholds are crossed and asset values compound. Imagine a founder in California whose company is growing. If the founder believes future rules will become less predictable and leaving later will trigger a larger tax event, what do? They do not wait until the company is 10 times bigger. They restructure earlier. They shift where future growth sits. They adjust holding companies. They build options. They reduce single-point exposure. And none of that shows up as a dramatic exodus headline. It shows up as quieter signals first. A slower hiring plan. A delayed investment. A new entity formed elsewhere. A new long-term lease signed somewhere else. That is the beginning of capital exit. Not the passport stamp, not the moving truck. This is the second critical clarification. Exit taxes do not trap capital inside a system. They accelerate planning. They pull future decisions into the present. They make the most mobile actors behave sooner. And once enough of that behavior stacks up, the economy can weaken even while official tax receipts still look fine. Now let us talk about the part that directly hits everyday Americans, because this is where the story stops being abstract. When people chant, "tax the rich," I understand it. Most people are not asking for revenge. They are asking for relief. They see housing costs, healthcare costs, tuition, insurance, and they want the people at the top to carry more weight. That instinct is human. The problem is that in real systems, you do not tax a person. You tax a base. Income, capital gains, corporate profits, property, consumption. And the base you can reach most reliably is the base that cannot move. When the most mobile capital reduces exposure legally, the system still needs revenue. Governments still have budgets. Debt still needs servicing. Services still need funding. So what happens? The burden shifts toward what is sticky: payroll, consumption, fees, compliance, small business audits, property taxes. That is why so many places end up with a pattern where headline taxes target the top, but the broad, unavoidable taxes expand underneath. And that is how average working people end up paying to make up what the system expected to collect from mobile capital. Not because anyone planned it as a conspiracy, but because that is how incentives resolve. Now I'm going to give you what I promised, and this is the part most people never hear explained clearly. This is the checklist, not a fantasy escape plan, not a political rant, a practical set of signals you can monitor the same way analysts, investors, and institutions do. If you understand these signals early, you see pressure building before it shows up in your rent, your taxes, your job market, or your quality of life. Stay with me all the way through, because the final signal on this list is the one most people ignore, and it is often the earliest and most honest warning of all. First, watch how often tax rules change, not how high the rates are. This is critical. A high tax rate that stays stable for 10 or 20 years is far easier for capital to live with than a moderate rate that changes every budget cycle. Businesses and investors plan years ahead. When tax rules are rewritten frequently, it signals political volatility. And volatility destroys long-term planning faster than any single tax hike ever could. Even if today's rate looks manageable, constant change tells capital that tomorrow's rules are unknowable. That alone is enough to slow investment. Second, watch for exit tax expansions and aggressive enforcement changes. These are not neutral policies. They are defensive moves. When governments introduce taxes on unrealized gains at departure, tighten reporting rules, or expand audit reach, They are signaling concern about capital leaving. The unintended effect is timing. These policies pull future decisions into the present. People restructure earlier. They move ownership earlier. They reduce exposure earlier. The exit may not happen immediately, but the economic disengagement already has. Third, watch the gap between short-term revenue and long-term investment. This is where many people get fooled. A country can report strong tax revenue while its future base is quietly shrinking. If government revenue holds steady but venture capital slows, factory investment declines, and multi-year infrastructure commitments thin out, that is an early-stage warning. Long-term capital leaves first because it is hardest to replace once gone. Fourth, watch skilled professionals, not just billionaires. When doctors, engineers, senior managers, and founders begin building foreign options, working internationally, or relocating parts of their operations, institutional strength weakens. These people are not chasing headlines. They are responding to risk. And they are the operational spine of the economy. When they loosen their roots, recovery becomes far harder. And now the final signal, the one most people miss. Watch where new businesses choose to incorporate and where they choose to hire. Not what politicians promise. Not what press releases say. Incorporation and hiring are confidence votes. Capital always votes early, quietly, and legally. If new companies increasingly choose other jurisdictions for headquarters, holding companies, or major hiring, that tells you the direction of flow long before any headline admits it. If you track those signals, you stop being surprised. You stop reacting late. You do not need fear. You gain timing. Most people will not believe these shifts are real until prices rise, services thin, and opportunity narrows. That is how these cycles work. Quietly first, publicly later. If this helped you, like the video and subscribe so I can keep making these explanations for the people who are trying to stay financially unbreakable while the system gets noisier. And tell me in the comments what you are seeing where you live. I read all comments and emails personally, so do not hesitate to share your experience or your question, because your pattern might be the warning someone else needed before the consequences became permanent.